Shares of new age companies have been in vogue on the bourses for some time now. Over the past 3 months, new age stocks have outperformed the markets, led by a near 30% surge in shares of Zomato. By comparison, the Nifty 50 index is up just 1% during the period. The new lease of life, analysts say, is a result of company managements shifting their focus on profitability.
When these IPOs hit the market, it was a divided house on valuations. One school of thought was that these are high growth stocks, so can't be valued using the traditional valuation techniques, whereas the old school was still looking for cash flows. The old school finally prevailed, and the managements of these listed new age companies had to have clear timelines for profitability and needed to meet their milestones on a quarterly basis. Those which showed the inclination and were able to match up have been acknowledged, and this reflects in the stock prices in the last couple of months.
During the September quarter of FY24, FSN E-commerce Ventures, the parent of Nykaa, reported a 50% year-on-year surge in net profit. This comes after it had reported a mere 8% year-on-year rise in net profit in quarter 1 FY24, but a fall of 72% in the fourth quarter of FY23 and 68% in the third quarter of FY23. Food delivery platform Zomato, meanwhile, delivered its second quarterly net profit worth Rs 36 crore in second quarter FY24. Paytm, on the other hand, has been narrowing its losses consistently while improving EBITDA gains quarter on quarter. The strengthening bottom lines, along with stable profit margins, are thus acting as tailwinds for the companies. That apart, a favorable interest rate scenario too is auguring well for these stocks as new age companies use discounted cash flows to value their firms, which is a function of interest rates.
Every time the internet stocks start rallying aggressively, whenever the interest rates start falling, because they are a function of demand, and demand is spurred by reducing interest rates. Along with the pickup in demand, it also affects the valuations, which are based on the DCF methodology. And what happens is that when you are doing the DCF methodology of valuation, the interest rate which is used to discount the future, as it falls, it raises the fair value of the net present value of the stock price.
That said, analysts suggest investors selectively buy new age stocks on dips.
Now, will all the stocks rally? I think it's going to be a mixed bag. Zomato, in my opinion, is a clear beneficiary, and Honasa is another stock that we think will go up against the market expectations. And Jio has a very, very strong balance sheet, which currently Paytm does not have. Also, Paytm Bank's operations have been kind of curtailed by the RBI, given the existence of a Chinese stake in the company.
The sentiment around shares of new age companies is on the mend. From broad-based sell calls, analysts are giving thumbs up to these companies as they have shifted their focus on sustainable profits. But they suggest investors wait for dips to enter the counters. Today, on the 17th of November, global cues and stock-specific action will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's moving from employee to employer. Business Standard.